Welcome back to Gold Rush Reporter. I'm your silver analyst. And today, we need to talk about something that's shaking up the global markets once again. The silver squeeze. I know you've probably heard that term countless times before, but this time it's different. The situation unfolding right now could be one of the most critical turning points for silver we've seen in years, and I'll explain exactly why. Before we get into the details, make sure to hit that like button, share your thoughts in the comments about where you think silver is headed next, and subscribe so you don't miss what's coming next. Because what's developing could hit the market faster than most people expect. Now here's where it gets serious. I recently received information from a highly credible source, someone with inside access to developments that haven't yet reached the mainstream. I can't confirm every detail right now, but what I can tell you is that there's growing activity linked to the military sector, and silver seems to be playing a key role in it. That alone should make anyone in the precious metals space stop and pay attention. The strange thing is how fast this shift has taken place. The pressure in the silver market never really went away. It just went underground. And now, it's resurfacing with intensity. Despite recent price swings, we're still sitting in a stage of extreme tension between supply and demand. Every move matters now. Recent numbers make that clear. Silver prices have climbed sharply in the London market, recently hitting around $54.50 per ounce. Even if that adjusts slightly, it shows that something major is happening beneath the surface. A big part of it is arbitrage. Traders are jumping on the price gaps between the US dollar markets and the Asian exchanges, and that gap has widened dramatically in recent weeks. But it's not just speculation. Data from the Shanghai Gold Exchange shows that silver vaults have fallen by 6,693 kilograms, reaching an all-time low. That kind of drop doesn't happen without serious movement. It signals increasing industrial demand and heavy institutional accumulation. This isn't an isolated event. The East and the West are finally balancing each other out in terms of silver flow, and that's something we haven't seen before. For decades, most of the pressure was concentrated in Western markets like COMEX and the LBMA. Now the East, led by China, is pulling in enormous volumes of silver and putting strain on global reserves. If we link this to the geopolitical landscape, especially rising military tensions across Asia, the picture becomes even more concerning. I'm not jumping to conclusions, but when falling inventories, military-linked demand, and sharp price moves all happen together, it's not a coincidence. It's a setup for major volatility. The situation we're seeing right now between Shanghai and London is unlike anything the silver market has experienced before. For decades, London has been the center of the world's precious metals trade. Bars moving through a tight network of vaults handled by a few major banks, with benchmark prices set and adjusted daily. But recently, that system has started to break down. The flow of silver that used to move seamlessly through those channels is now being disrupted and redirected, and most of it is being pulled toward China. Reports from the Shanghai Gold Exchange confirm that vault inventories have dropped sharply, hitting levels that haven't been seen in years. That kind of depletion doesn't just happen because of investor interest. It signals industrial and governmental demand, possibly even military-related purchases. Meanwhile, London vaults have been sitting near dangerously low levels for months, and the convergence between these two markets shows how global supply is being squeezed from both ends. Arbitrage traders have been trying to take advantage of these gaps, but the window for profit has become thinner and riskier. As prices move faster and shipments take longer, moving physical silver between regions isn't as simple as it used to be. What used to travel in secure transport vehicles across Europe is now being flown in bulk by cargo planes across continents. That's not a minor detail. It shows the logistical pressure the market is under right now. The costs of transporting silver have increased dramatically, and in some cases, buyers are reportedly paying premiums that were once reserved for gold just to move silver internationally. At the same time, China's domestic market is showing signs of tightness. According to analysts like Vince Lancy, silver production in key provinces such as Henan, Yunnan, Shandong, and Zhejiang fell by over 3.5% in just 1 month. That's a big deal when you consider how dependent global industry is on China's refining and production capacity. On top of that, exports spiked in October, draining even more metal out of the country's internal market. Maintenance shutdowns at copper and lead zinc smelters have only made things worse. When copper operations pause for maintenance, the silver that's normally extracted as a byproduct also slows down. It's a double hit: less domestic output and increased exports. Meanwhile, smelters that process lead have managed to keep production steady because of high refining margins. But even that might not hold for long if raw material quality keeps falling. So what we have here is a perfect storm: falling domestic production, heavy export demand, and international vaults running dangerously low. All of these factors combine to create a scenario where silver availability can tighten sharply at any moment. The interesting thing is that despite all this, the spot market in China is still holding firm, with premiums rising to as much as 50 yuan per metric ton. That means local buyers are willing to pay extra just to secure immediate delivery, and that's never a healthy sign for long-term supply stability. What this tells us is simple. The silver squeeze that everyone thought had passed hasn't gone anywhere. It's just shifted its center of gravity. It's no longer a retail-driven event like the one we saw in 2021. This is an institutional squeeze fueled by industrial needs, government strategy, and geopolitical uncertainty. And the deeper you look, the more you realize how fragile this balance really is. As the balance of silver trade shifts from west to east, the implications go far beyond short-term price action. What we're witnessing is a slow but powerful restructuring of how silver is sourced, priced, and moved globally. London's traditional dominance is fading, and the Shanghai Gold Exchange is stepping up as a genuine counterweight. That shift isn't just symbolic, it's financial and strategic. For years, Western institutions controlled the benchmark prices and the flow of bullion. Now the East is setting the tone, both in supply and demand, and that's forcing traders and investors to rethink how the market operates. Right now, silver that used to circulate easily between London, Zurich, and New York is being rerouted through Asia. Some of that is because of logistical efficiency, but a lot of it has to do with who's willing to pay more. Chinese buyers are consistently offering higher prices than their Western counterparts, creating what traders call a pull effect. The result is that more physical silver is leaving Western vaults and heading east. At the same time, industrial demand in Asia, especially for electronics, solar panels, and battery technology, continues to rise sharply, creating a structural drain on the available pool of silver. Another point that's often overlooked is how governments and state-backed institutions are positioning themselves. When you see large-scale movements of silver from commercial vaults into less transparent channels, that's often a clue that the metal is being stockpiled for strategic or industrial use, not for investment. There are growing indications that a portion of China's recent silver accumulation could be linked to defense manufacturing or advanced technology projects. That would explain why the military was even mentioned in connection with this issue. The problem with this kind of accumulation is that it makes the market incredibly tight. Once silver is pulled into strategic reserves, it doesn't come back out. It's locked away for long-term use. Meanwhile, Western vaults, like those managed under the LBMA system, have already been sitting at historically low levels. Combined with declining mine output and slower refining activity, the supply picture looks weaker every month. This is why even small disruptions, such as smelter maintenance or export surges, are now triggering noticeable price volatility. In simpler terms, the silver market has become fragile. It doesn't take a major crisis anymore to move prices sharply. A single report about declining inventories or shipping delays can send futures contracts spiking or collapsing within hours. That level of sensitivity shows just how stretched the physical market really is. Another interesting detail here is how arbitrage opportunities, once a routine profit mechanism, have turned into a sign of imbalance. When traders move metal between regions to exploit price differences, it's supposed to keep the market stable. But lately, those gaps aren't closing as fast as they should. That's because there isn't enough physical silver available to move freely. The market is signaling that the liquidity of silver, the ability to get it when and where you need it, is drying up. For long-term investors, that's both a warning and an opportunity. On one hand, volatility will continue to punish anyone trying to time short-term moves. But on the other, these conditions tend to lead to higher equilibrium prices once supply and demand finally settle. If you hold silver with a multi-year outlook, this tightening could mark the beginning of a long-term repricing cycle. The pressure building in the silver market isn't just about supply and demand anymore. It's about who controls the narrative. For decades, the London Bullion Market Association and the COMEX exchange in New York dictated global pricing. But that dominance is slipping fast as Asia gains control over the physical metal. What used to be a Western-controlled paper game is now shifting toward an Eastern-controlled physical market. That transition is huge because it changes how value is determined, not by futures contracts, but by real-world access to actual silver bars. In Shanghai, the situation has turned intense. Inventories are plunging, with smelters prioritizing exports over domestic supply just to capture high premiums abroad. Those export premiums, often 30 to 50 yuan per ton, sound small, but in large volume trading, they're massive. It's a clear signal that the local market is struggling to keep up with both industrial and investment demand. As silver continues to leave Chinese vaults, the question becomes, who's buying and why now? The answer points to a mix of industrial giants, government-backed programs, and yes, possibly military procurement. The military angle might sound speculative, but when major resource flows become opaque and untraceable, it's usually tied to national strategy. Meanwhile, the Western side isn't immune. LBMA vaults have been sitting at dangerously low levels, and the US Mint's ability to source silver blanks for coin production has been spotty all year. These cracks are widening. When the physical supply chain becomes unreliable, investor confidence shifts. That's why you're seeing increasing premiums on physical bullion, coins, bars, and rounds, even when the spot price lags behind. It's not a price discrepancy, it's a trust discrepancy. People are paying more because they want metal in hand, not just a digital promise. This is also where market psychology kicks in. As more investors realize that silver supply is tightening globally, fear and speculation start to feed off each other. Every small news report about smelter issues, shipping delays, or political tensions acts like fuel on an already sensitive fire. That's the kind of sentiment that can trigger a full-scale squeeze. Not the retail-driven hype we saw a few years ago, but a real structural one, where industry and institutional buyers compete directly with retail investors for limited physical metal. We're already seeing signs of that with how fast premiums spike and fall. Dealers can't even maintain consistent pricing from one week to the next. If this trend continues, it won't be long before the spot price becomes irrelevant to the physical trade. Something we've already started to witness in certain corners of the gold market. The silver market is following that path, just with far more volatility. From an analytical standpoint, this is the stage where things either stabilize or break. If new supply doesn't come online soon through increased mining output or reduced exports, the imbalance will deepen. The next few months will be critical because the West still needs silver for everything from solar panels to EV batteries, and if the East keeps absorbing supply, the scramble will intensify. So, here's where everything ties together. The silver squeeze we're watching right now isn't some social media stunt or speculative frenzy. It's a real-world reflection of how fragile and globally dependent this market has become. The London vaults are thinning out, Shanghai's inventories are plunging, and refiners are pushing exports just to stay ahead of rising premiums. Every signal points to one unavoidable conclusion. Physical silver is getting harder to find, and the world is waking up to that reality. When you combine tight supply, export surges, and geopolitical pressure, you get the perfect setup for a long-term revaluation of silver. Whether you're a trader, a stacker, or an analyst, the takeaway is simple. Stop chasing daily price moves and start watching where the metal is actually going. Because wherever the silver flows, that's where the power flows next. I've said it before, silver is not just a precious metal anymore. It's an industrial necessity, a financial hedge, and increasingly, a strategic asset. The East understands that. The West is catching up, but late. What happens next will depend on how these two sides manage this imbalance, whether through cooperation or through competition that drives prices far higher than most expect. If the current trends continue, declining domestic output in China, reduced refinery throughput, and constant demand from tech and defense sectors, we could see the market break through its current resistance range faster than many anticipate. Once that happens, you'll see institutions and funds that have been ignoring silver suddenly scramble to get exposure. And when they do, the retail stackers who've been quietly accumulating will be the ones sitting in the strongest position. It's easy to underestimate silver because it doesn't move like Bitcoin or tech stocks. But unlike those assets, silver is finite, tangible, and necessary for everything from electronics to clean energy infrastructure. That's why, no matter how volatile things get, my stance remains the same. Stay informed, stay rational, and stack responsibly. Don't chase hype, but don't ignore opportunity either. As we move into the next few months, watch the Shanghai vaults, monitor London's inventory data, and pay attention to export activity. Those are the indicators that will tell you what's really going on. Not headlines, not sentiment. Because when the next leg of this squeeze hits, it'll happen quietly at first, and then all at once. Thanks for sticking with me through this breakdown. If you found this analysis useful, make sure to hit like, drop your thoughts in the comments, and share this with someone who still thinks silver is just another commodity. You've been watching Gold Rush Reporter, and I'm your silver analyst, bringing you the hard facts, not the hype. Stay sharp, stay informed, and as always, keep stacking smart.